Here's a question that might seem simple. What does a conflict in the Persian Gulf have to do with your mortgage rate? The answer runs through a chain of events that most financial media doesn't fully explain. Oil prices, inflation, treasury yields, and finally, the stock market and every other asset you own. Right now, in late May 2026, that chain is fully active, and it's evolving by the day. The Iran war sparked the largest oil supply disruption in history. The oil shock pushed U.S. inflation to a three-year high. That inflation drove Treasury yields to their highest levels in nearly 2 decades, and those rising yields are now shaping everything: your stocks, your bonds, your mortgage, your savings rate, and even your grocery bill. But here's what makes this moment so critical. As of today, May 30th, 2026, oil prices are falling sharply on ceasefire optimism. The US and Iran are closing in on a 60-day memorandum of understanding to extend the ceasefire and restore Strait of Hormuz shipping flows. Brent crude has dropped to $92.56, down nearly 20% from its 2026 peak. WTI is at $87.18. Oil just had its worst month since the COVID pandemic. This means the scenario the market has been pricing in, de-escalation, is now actively being negotiated. In this video, we're going to walk through the entire chain step by step. We'll explain each connection clearly, look at the actual numbers, and then examine what the charts are telling us right now about where markets are headed next. This is the full picture. Let's get into it. On February 28, 2026, Iran's Revolutionary Guards began broadcasting radio warnings that ship passages through the Strait of Hormuz were, quote, not allowed. Within days, the effective closure of the world's most critical oil shipping lane had begun. By March 4th, tankers had stopped moving. Qatar Energy declared force majeure on all its liquefied natural gas exports. The International Energy Agency described what followed as, and I'm quoting directly here, the largest supply disruption in the history of the global oil market. A ceasefire was announced on April 8th, but as of late May 2026, ship traffic through the strait remains well below pre-war levels. Now, here's the breaking development. As of this week, the US and Iran have reached a tentative deal to extend that ceasefire for 60 days and begin nuclear talks. The agreement would fully reopen the Strait of Hormuz with no tolls or restrictions. President Trump has called it, quote, largely negotiated. Secretary of State Rubio says the US will give talks every chance to succeed. Neither Trump nor Iran's leadership has formally signed off yet. Key sticking points remain: Iran's uranium stockpile, frozen assets, and the situation in Lebanon. But the direction of travel is unmistakable, and oil markets are pricing it in aggressively. To understand why this matters so much, you need a quick geography lesson. The Strait of Hormuz sits between Iran on the north and the UAE and Oman on the south. At its narrowest, it's only 29 nautical miles wide, roughly 54 kilometers. And within that narrow gap, there are just two usable shipping lanes. Each one is 2 nautical miles wide. Inbound traffic in one, outbound traffic in the other. Through those 2 lanes passes roughly 20 million barrels of oil per day. That represents about 20% of all the petroleum consumed on the planet every single day. Let that number sink in. 1 in every 5 barrels of oil that powers the global economy. Every car, every factory, every heating system, every airplane passes through a channel that is 2 miles wide. And it's not just oil. Approximately 20% of global liquefied natural gas trade also flows through the strait, primarily from Qatar, which is one of the world's largest LNG exporters. Here's what makes this even more critical. Most of the countries producing that oil, Saudi Arabia, Iraq, Kuwait, the UAE, Iran itself, have no practical alternative route. Saudi Arabia has a pipeline to the Red Sea coast, but its maximum capacity is about 5 million barrels per day. That's a quarter of normal Hormuz flow. There is no other way to move the rest of it. When the strait is threatened, global energy markets don't wait and see. They price in the risk immediately. And when the threat eases, they price that in just as fast. When the strait effectively closed in early March, oil markets moved with stunning speed. In February 2026, the average price of Brent crude was around $74 a barrel. By March, that average had jumped to $103 a barrel, a 45% surge in 1 month. At the peak, Brent crude crossed $120 a barrel. That is a price level the world hadn't seen since the aftermath of the Russian invasion of Ukraine in 2022. Today, as of May 30th, Brent is trading at $92.56, and West Texas Intermediate, the U.S. benchmark, is at $87.18. Oil has fallen nearly 20% from its 2026 peak. May 2026 will go down as the worst month for oil prices since the COVID pandemic. Goldman Sachs now forecasts Brent at $90 per barrel for the fourth quarter of 2026, a projection that suddenly looks right on track if the ceasefire holds. The U.S. Energy Information Administration had projected the full year 2026 Brent average at $96 a barrel. If the MOU is signed, that number will be revised down sharply. The war premium is unwinding, but it hasn't fully disappeared yet. Prices are unlikely to return to the $60.70 level seen before the conflict, not while uncertainty remains. This is the part that most news coverage glosses over, so let's be explicit about the mechanism. When oil prices spike, the first impact is immediate and visible. Gasoline and diesel prices at the pump rise within days. That's the price you see on the sign when you drive past a gas station. But the second wave, the one that's harder to see but economically more significant, is the cost transmission through the entire supply chain. Think about everything that requires energy to produce or transport. Manufacturing uses electricity and natural gas. Freight trucks run on diesel. Cargo ships burn heavy fuel oil. Airplanes burn jet fuel. Agriculture uses diesel machinery, natural gas-based fertilizers, and fuel to refrigerate and ship food. When oil costs 45% more, all of those input costs rise. And when companies face higher input costs, they do one of two things. They absorb the hit to their profit margins, or they raise prices. Most raise prices. That's how oil becomes inflation, not just at the gas station, but in your airfare, your delivery charge, your grocery bill. The Dallas Federal Reserve quantified this specifically for the 2026 shock. The Iran war oil disruption is expected to push U.S. headline inflation up by 0.6 percentage points and core inflation up by 0.2 percentage points over 2026. We're not projecting this anymore, we're measuring it in real time. April 2026 CPI came in at 3.8% year over year, the highest reading since May 2023. Energy prices within that report were up 17.87% year over year. Gasoline up 18.9%, fuel oil up 44.2%, and the Fed's preferred inflation measure, the Personal Consumption Expenditures Index, came in even hotter than expected. Core PCE for April was 3.3% year over year, released just 2 days ago on May 28th. That is the highest reading in over a year and above every major forecast. Consumer savings have fallen to just 2.6% of income, a two-decade low, as households burn through reserves to keep up with rising prices. Consumer inflation expectations are rising too. The University of Michigan's 1 year ahead inflation survey jumped a full percentage point to 4.8%. That matters because the Federal Reserve watches those surveys closely. When people expect higher inflation, they start demanding higher wages and accepting higher prices, which can turn a supply shock into a self-sustaining inflation problem. To understand this section, you need to understand one fundamental truth about bonds. A bond is a fixed promise. If you buy a 10-year U.S. Treasury note today, the government promises to pay you a fixed interest payment called the coupon for 10 years and then return your principal. But here's the problem with fixed promises in an inflationary world. If inflation is running at 3.8% and your bond pays you 4%, your real return after inflation eats into the value of those payments is almost nothing, less than nothing if inflation goes higher. So when inflation expectations rise, bond investors have a choice: hold existing bonds that don't keep up with inflation, or sell them, which drives bond prices down and bond yields up. That's exactly what has happened. Investors are selling US Treasury bonds, and when prices fall, yields rise. Here are the actual numbers. The 30-year Treasury yield briefly hit 5.197% in mid-May, its highest level since July 2007, before the 2008 financial crisis. The 10-year Treasury yield peaked at 4.687%, its highest level since January 2025. The 2-year yield sits near 4.025%. As of today, yields have pulled back slightly. The 10-year is near 4.45% and the 30-year near 5.18%, as the ceasefire MOU news has given bond markets a brief respite. But yields remain elevated by historical standards. CNN reported the 30-year Treasury yield hit its highest level in 19 years. CNBC called it a bond rout. Wolf Street put it plainly: bond markets are warning that inflation could prove much stickier than many investors anticipated. And it's not just domestic US concerns driving yields higher. Investors are demanding higher compensation for three things simultaneously: the inflation risk from the oil shock, deterioration in the US fiscal position — remember, Moody's downgraded US credit earlier this year — and geopolitical uncertainty that, while easing, hasn't fully resolved. This is a multi-factor bond sell-off, and it has direct consequences for everything that gets priced off Treasury yields. Stocks are valued based on future cash flows, the profits companies are expected to generate over time, discounted back to today's value. The discount rate used in that calculation is tied to Treasury yields. When Treasury yields rise, the discount rate rises, and when the discount rate rises, the present value of every dollar of future earnings falls. This is why rising yields tend to pressure stock prices, particularly growth stocks and technology companies that generate most of their earnings well into the future. The further out those future profits are, the more dramatically they get discounted when rates rise. It's also why the 30-year Treasury yield matters even for equity investors. A 5.2% risk-free return from a government bond is genuinely competitive with the earnings yield on the S&P 500. When yields are that high, some investors, particularly institutional allocators, rotate out of equities and into bonds. That selling pressure hits stocks. There's a second mechanism too. Higher Treasury yields translate directly into higher borrowing costs for the entire economy. Higher corporate borrowing costs mean lower investment and lower margins. Higher consumer borrowing costs, like mortgage rates, slow housing and consumer spending. Both reduce future corporate earnings, which reduces stock valuations again. This is the yield to stock market transmission chain, and right now it's fully activated. Let's go through each of the key areas one by one. The S&P 500 reached an all-time high near 7,000 in January 2026. When the Strait of Hormuz closed in early March, the index sold off sharply, down about 5% in a matter of weeks. But here's what's remarkable. Despite elevated oil prices, rising inflation, and surging Treasury yields, the S&P 500 has not only recovered, it has pushed to a new all-time high. As of May 29th, the index closed at 7,585. The S&P 500 just completed its 9th consecutive week of gains, 9 weeks in a row. Why? Markets are pricing in de-escalation of the Iran conflict, which is now being actively negotiated. Add to that continued strength from artificial intelligence spending across major technology companies. Microsoft gained 3% this week, Oracle rose over 6%, Dell surged over 30% on AI server demand. The AI narrative has proven powerful enough to override the macro headwinds. That's the bull case. And right now, the market is more confident in it than at any point since the war began. The Nasdaq composite also pushed through to a new record above 24,000. The Nasdaq 100 is up 8% in the month of May alone, a remarkable rebound from the rate-sensitive sell-off in March. The Nasdaq underperformed the S&P 500 during the March sell-off, which is exactly what you'd expect, given that tech companies carry high earnings multiples and are particularly sensitive to interest rate changes. But the AI narrative proved powerful enough to override the macro headwinds on the recovery. This is where the clearest winner has been. The Energy Select Sector Spider Fund, ticker XLE, is up approximately 24% year to date, and was up as much as 36% at its peak when oil crossed $120 a barrel. ExxonMobil and Chevron both hit all-time highs earlier in 2026 on that oil surge. Institutional investors rotated heavily into large-cap energy stocks as safe havens, a designation that historically belongs to gold and defensive sectors. However, note that with oil prices now down nearly 20% from their 2026 peak, the war premium is actively unwinding from energy stocks. That 36% gain has already pulled back to 24%. If the MOU is signed and the strait fully reopens, more of those gains will unwind quickly. For ordinary Americans, the impact is already visible. Gas prices are up nearly 19% year over year. Fuel oil is up 44%. Airline tickets are more expensive. Grocery prices are being pushed higher by rising transportation and packaging costs. The mortgage rate story illustrates the full chain perfectly. Iran war, then oil spike, then inflation, then Treasury yields rise, then mortgage rates follow, then American families pay more every month for the same house. The 30-year fixed mortgage rate now sits at 6.51%, driven directly by the spike in 10-year Treasury yields. That chain runs from a narrow waterway in the Persian Gulf directly to your home loan payment. Let's look at the technical picture across the key markets right now. The S&P 500 has pushed to new all-time highs above 7,500, now trading at 7,585. From a pure technical standpoint, that's bullish. Price discovery means no overhead resistance from prior sellers. 9 consecutive weekly gains confirms the strength of the trend. But momentum indicators suggest the market is approaching overbought conditions at these levels. The move from the March low to the current ATH has been steep and largely uninterrupted. Historically, markets that recover quickly from a geopolitical shock then require a period of consolidation before the next leg higher. Key support to watch on the downside, the 7,200, 7,300 zone, which represents the prior breakout area. A meaningful close back below 7,000 would be a technical warning that the recovery rally is failing. On the upside, if the S&P 500 holds above 7,400 on any short-term pullback, the technical structure remains constructive for the rest of 2026. The Nasdaq is also in price discovery above 24,000. For a market that was selling off as recently as March, down more than the S&P 500 due to rate sensitivity, this is a remarkable recovery. Watch the 23,500 zone as the key support area. That level contains both the 50-day moving average and the prior resistance that now becomes support. A drop back below 23,000 with volume would be a meaningful warning sign. WTI crude is now trading at $87.18 per barrel, and that number is critically important for what comes next. Here's why. Earlier in this video, I told you that $80 is the key floor for WTI. Above $80, energy-driven inflation stays elevated and the Fed is unable to cut rates. Below $80, the picture changes dramatically. Inflation pressures ease, Treasury yields fall, and the Fed regains the ability to act. At $87.18 today, WTI is now just $7 above that critical $80 level. A signed ceasefire MOU and meaningful strait reopening could push oil below $80 in a matter of weeks. That would be the single biggest positive catalyst for the U.S. economy and financial markets since the war began. Watch this level closely. $100 remains the ceiling on the upside. A reversal of ceasefire talks and renewed escalation would push oil back above $100, reignite the inflation narrative, and reverse the current market rally. The current $87 zone is where the de-escalation scenario and the geopolitical risk premium are arm wrestling. The ceasefire talks are winning right now. For Treasury yields, the levels that matter most are the 10-year yield at 4.5% is the current equilibrium zone. It reflects the market's baseline expectation of moderate inflation and a Fed on hold. At 4.7%, you start seeing meaningful equity multiple compression. Above 5% on the 10-year, you are in territory that historically triggers financial stress. Mortgage demand falls sharply, corporate refinancing costs spike, and highly levered companies face distress. The 30-year yield already briefly touched 5.2%, a pre-2008 level. It's now pulling back slightly toward 5.18% on ceasefire news, but inflation data is keeping a floor under yields. Core PCE at 3.3% is not a number that lets bond markets relax. The Federal Reserve is sitting at a 3.50% to 3.75% policy rate. And there's an important personnel update. Kevin Warsh became the new Federal Reserve Chair following Jerome Powell's departure after the April 29th FOMC meeting. Warsh inherits an institution deeply divided. The April meeting produced 4 dissenting votes, the most since 1992. In a normal economic slowdown, the Fed cuts rates to stimulate growth. In a normal inflation episode, the Fed hikes rates to cool prices. But this is neither of those clean scenarios. This is a supply shock. Oil is expensive not because the economy is overheating. It's expensive because a geopolitical conflict is blocking 20% of global supply. The Fed cannot drill more oil, it cannot reopen the Strait of Hormuz, it cannot fix a supply-side problem with a demand-side tool. If the Fed cuts rates to protect growth, it risks allowing inflation to embed further, potentially de-anchoring inflation expectations. If it hikes rates to crush inflation, it risks pushing an already fragile economy into recession. Ray Dalio said it clearly in April. The US is already in stagflation, and a Fed that loses credibility would make it worse. Here's how dramatically market expectations have shifted. Interest rate markets now show 0 probability of cuts in 2026 and a 40% probability of a rate hike by December. That's a seismic shift from just 3 months ago when markets were pricing in multiple cuts. Core PCE at 3.3% made that shift happen. The probability of a US recession in 2026 sits at 42% according to Moody's Analytics. Let's lay out the 3 paths forward clearly. Scenario 1, de-escalation. This is the scenario that is now actively being negotiated. The MOU is signed. The Strait of Hormuz reopens meaningfully. Oil falls below $80 per barrel. Inflation moderates toward 2.5%, 3% by year-end. The Fed under Chair Warsh is able to avoid a hike and possibly executes one small cut in late 2026. Treasury yields pull back toward 4%. Stocks push to new highs. Energy stocks give back some gains as the war premium fades. This is what equity markets are currently pricing in, and it is gaining real-world momentum. Scenario 2, status quo. The MOU stalls over Iran's uranium stockpile or the Lebanon conflict. Oil stays in the $85, $95 range, as it is today. Inflation remains sticky at 3.5%, 4%. The Fed holds rates all year. Treasury yields stay elevated with the 10-year between 4.4% and 4.7%. The S&P 500 consolidates, sideways with volatility. Energy stocks stay firm. Tech and consumer stocks face headwinds. This is the muddle-through scenario. Scenario 3, escalation. Talks break down entirely. Iran resumes blocking the strait. Oil surges back above $130 and potentially toward $150. Headline CPI breaks above 5%. Inflation expectations de-anchor. The Fed under Warsh is forced to hike aggressively. The policy nightmare. The S&P 500 drops 15% to 20% from its all-time high. The Nasdaq falls harder. Energy stocks surge, but the broader economic damage accelerates. Recession risk rises above 60%. Markets are currently assigning this a low probability, but it is not zero. Here's the complete chain that we've walked through today. The Iran war threatened the Strait of Hormuz. The strait handles 20% of global oil. The disruption sent oil prices up 45% in a single month. Oil is an input cost for everything, so higher oil equals higher inflation. April 2026 CPI reached 3.8%, a three-year high. Core PCE hit 3.3%, the highest in over a year. Higher inflation drives bond investors to demand higher yields, so Treasury yields surged, with the 30-year briefly hitting its highest level since before the 2008 financial crisis. Higher Treasury yields increase borrowing costs everywhere, from corporate debt to mortgages. Rising mortgage rates and inflation are squeezing American consumers. Consumer savings have hit a two-decade low. The S&P 500 and Nasdaq have recovered to new all-time highs, now on 9 consecutive weeks of gains, pricing in the optimistic scenario. Energy stocks are the clear winner of this environment, but inflation is still running hot. The new Fed chair faces an impossible dilemma, and the ceasefire MOU is not yet signed. The most important levels to watch right now: WTI crude at $80 on the downside. That's where the de-escalation scenario becomes economically transformative. The 10-year Treasury yield at 4.7%, the level that would force equity investors to reassess valuations, and the S&P 500 support zone at 7,200, 7,300. The next 30 days will determine which of these three scenarios is winning. If you found this breakdown useful, please hit subscribe. We do this kind of deep macro analysis every week, connecting the geopolitical dots to what it means for your investments. Drop a comment below. Are you positioned for de-escalation, or are you still hedging for the tail risk? I'd love to hear your thinking. Everything in this video is for educational purposes only. It is not investment advice. Please do your own research and consult a qualified financial professional before making any investment decisions. See you in the next one.